You know, folks, I've been watching markets for over 75 years now, and there's something happening with Palantir Technologies that reminds me of a party that's gone on too long. Everyone's still dancing, the music's still loud, but at some point, someone needs to call last call. Palantir just crossed a market capitalization of nearly $180 billion. Let me put that in perspective for you. That's more than the market value of companies like FedEx, Starbucks, or Boeing. One software company with $2.8 billion in annual revenue is supposedly worth more than Boeing, which generates $78 billion in sales and builds airplanes that fly millions of people around the world every day. Now, I'm not saying Palantir isn't a good company. They make interesting products. Alex Karp has built something innovative. Their data analytics platforms help governments and corporations make sense of complex information. But here's what I learned a long time ago from my teacher, Ben Graham. Price is what you pay, value is what you get. And right now, the price that investors are paying for Palantir has gotten so far ahead of what they're actually getting that it reminds me of another time, 1999 to be exact. We all remember how that ended. The mathematics are simple, but the consequences are severe. Palantir trades at a price-to-sales ratio exceeding 60 times. That means you're paying $60 for every single dollar of sales the company generates. Not profits, mind you, sales. Let me walk you through what I see and why this concerns me deeply. Because when valuation disconnects this violently from business fundamentals, history has taught us one immutable lesson. Mr. Market eventually sobers up, and the hangover is brutal. Let me start with a story. In 1999, people asked me why I wasn't buying internet stocks. Warren, you're missing out, they said. This time it's different. I remember sitting in my office in Omaha looking at companies trading at 100, 200, even 300 times earnings. And I couldn't find a way to make the math work. It wasn't that I didn't understand technology. It's that I understood arithmetic. Today, as I look at Palantir, I'm getting that same feeling in my gut. Palantir is currently trading at a price-to-earnings ratio that ranges from 204 to 244 times forward earnings, depending on whose estimates you believe. The trailing PE ratio is even more staggering, somewhere between 446 and 690 times earnings, depending on the calculation method. Now, some folks will tell you that's not expensive for a growth stock. They'll point to the revenue growth of 63% and say, see, Warren, you have to pay up for growth. But here's what they're missing. They're assuming that future is guaranteed. Let me explain intrinsic value the way I think about it. When I look at a business, I ask myself one question: what is this company's future cash flow worth today? That's it. It's not complicated. I estimate what cash this business will generate over its lifetime, discount it back to today's dollars using a reasonable rate, and that gives me the intrinsic value. If I can buy it for significantly less than that number, what Ben Graham called a margin of safety, then I'm interested. Palantir generated about $2.8 billion in revenue over the past 12 months. They're projecting revenues of approximately $4.4 billion for fiscal year 2025. That's impressive growth, really impressive. They earned about $1 billion in profits over the trailing 12 months, giving them roughly a 36% profit margin on an adjusted basis. These are strong numbers, but here's where we need to pump the brakes. At a market cap approaching $180 billion, the market is saying, we believe Palantir will continue generating these kinds of profits, not just this year or next year, but for many, many years to come, and that those profits will grow substantially and continuously. The market is pricing in perfection. It's pricing in a world where Palantir maintains its dominance, where no competitor catches up, where their government contracts remain secure, where their commercial business continues its explosive growth, and where the returns on all that software investment justify the spending. That's a lot of assumptions. And when you stack assumptions on top of assumptions, you're not investing. You're speculating. Let me show you the math another way. Palantir's price-to-sales ratio is about 64 times. That means you're paying $64 for every dollar of revenue the company brings in. Now, I've been investing for 7 decades. And I can tell you that price to sales ratios above 10 should make you nervous. Above 20, you should be very nervous. Above 60, you're in what I call greater fool territory. You're not buying based on what the business will return to you. You're buying based on your belief that someone else will pay an even crazier price tomorrow. Compare this to what I look for. When I bought Coca-Cola in 1988, I paid about 5 times sales for a company I understood would still be selling billions of bottles of Coke decades into the future. When I invested in American Express, I paid a reasonable multiple for a business with a durable competitive advantage. I could see their moat. I could understand their economics for the next 20, 30, even 50 years. Can anyone honestly tell me they can predict the data analytics software industry with that kind of certainty? The enterprise software market is expected to grow significantly, and Palantir operates in what many consider a critical niche, integrating disparate data sources and providing actionable intelligence. Their platforms, Gotham for government work and Foundry for commercial clients, are genuinely innovative. But innovation doesn't justify any price. Let me tell you why. Palantir has about 597 customers as of their most recent quarter. They closed 204 deals worth at least $1 million in Q3 of 2025, with total contract value reaching $2.8 billion, up 151% year over year. These are impressive metrics. Their U.S. commercial revenue more than doubled. But when you're already at $180 billion in market cap, you've already priced in years of this kind of performance. Here's what concerns me most. The law of large numbers is approaching faster than people realize. It's one thing to double revenue when you're a $500 million company. It's quite another when you're at $2.8 billion, and it becomes exponentially harder at $5 billion, $10 billion, or $20 billion. To justify the current valuation, Palantir needs to not just maintain growth, they need to accelerate it or sustain it for an impossibly long time. Let me walk you through a scenario. Palantir's market cap is roughly $180 billion. Let's assume you want to earn a 10% annual return over the next decade, which is a reasonable expectation for equity investments. That means the company needs to be worth about $467 billion in 2035. For that market cap to be justified, what does the business need to look like? Let's be optimistic and assume the market will still award Palantir a premium 30 times PE ratio in 2035, which would still be expensive by historical standards. That means the company needs to earn about $15.6 billion in net income. With their current 40% net margins, which are exceptional and difficult to sustain, that requires revenues of approximately $39 billion. Palantir's 2025 revenue will be around $4.4 billion. To get to $39 billion by 2035, they need to compound revenue at about 24% annually for 10 consecutive years. That's not impossible, but it's extraordinarily difficult. I've been investing for over 70 years. I can count on one hand the number of companies that have compounded revenue at 24% plus for a decade at this scale. But let's say I'm being too conservative. Let's say they grow revenue at 35% annually for the next 10 years, which would be exceptional performance. That gets them to about $61.5 billion in revenue by 2035. With 40% net margins, that's $24.6 billion in earnings. If the market awards them a 30 times PE, the stock would be worth about $738 billion. You paid $180 billion today. That's a 15% annual return. Not bad, you might say. But here's the problem. You're taking massive risk, assuming perfect execution and 35% annual revenue growth for a decade to earn 15%. You could earn similar returns with far less risk in other quality businesses trading at reasonable valuations. The risk-reward ratio here is completely inverted. You're taking maximum risk, paying peak prices at the height of AI and data analytics enthusiasm for moderate potential returns that assume everything goes perfectly right. Now let's talk about what could go wrong, because when you pay 200 times earnings, you're not being compensated for adversity. If revenue growth slows to 25%, still exceptional. the stock could easily have as the growth story moderates. If a competitor develops a comparable platform at a lower price point, margins could compress from 40% to 30%, costing billions in market value. If government spending priorities shift and defense budgets tighten, their government revenue, which represents 55% of total revenue, could stagnate. If they execute an ill-advised acquisition to accelerate growth into new markets, value could be destroyed. If key executives like Alex Karp or Stephen Cohen depart, continuity could suffer. If the commercial market proves harder to penetrate than expected, the growth story falls apart. Any one of these risks in isolation might be manageable, but when you've paid a price that assumes perfection, even normal business challenges become catastrophic for returns. This is the tyranny of high valuations. You've already paid for all the good news in advance. From here, the only surprises can be disappointments. I've lived through a lot of manias. I was investing during the nifty 50 craze of the 1960s and 70s. I watched the conglomerate boom and bust. I saw the Japanese asset bubble in the 1980s. But nothing compares to what I witnessed in 1999 and 2000. And what worries me today is that I'm seeing the same patterns again with companies like Palantir. In 1999, Barron's published an article titled, "What's Wrong, Warren?" They suggested I had lost my touch. My portfolio was down 21% that year, while the NASDAQ was up over 80%. Berkshire Hathaway stock was getting hammered. Investors were selling my stock to buy internet companies that had never earned a dollar of profit. It was painful to watch. I remember people telling me I didn't understand the new economy. They said I was an old man stuck in the past. They told me that the internet changed everything, that old valuation metrics didn't apply anymore, that I needed to get with the times or get left behind. Sound familiar? But here's what I knew then and what I know now. Business fundamentals don't change. A business is worth the present value of its future cash flows, period. It doesn't matter if you're selling software in the cloud or selling shoes in the store. The math is the math. During the dot-com era, I watched companies with minimal revenue trade at billion-dollar valuations. I saw business plans that essentially said, we'll spend enormous amounts on customer acquisition and eventually become profitable, though we can't tell you exactly when. It was mass delusion. People had convinced themselves that growth and market share would eventually translate into profits, even though they couldn't explain exactly how or when. Let me tell you what happened next. From March 2000 to October 2002, the NASDAQ fell 78%. Companies that were worth tens of billions became worthless or nearly worthless. Pets.com, Webvan, eToys, billions of dollars vaporized overnight. The market picked some of the right winners like Amazon, but even Amazon fell 95% from its peak before recovering. The lesson wasn't that the internet wasn't revolutionary. Of course it was. The lesson was that revolutionary technology doesn't justify any price. Even if you picked the winners, you still lost money if you paid too much. Amazon didn't return to its year 2000 stock price until 2009. That's 9 years of waiting just to break even. And that's if you held on through a 95% decline without selling in panic. Today, I'm watching history repeat itself with artificial intelligence and big data stocks, and Palantir is at the center of it. The company has become a proxy for the AI revolution, with investors treating it like a must-own stock for exposure to artificial intelligence. But let me ask you a question. Is Palantir really an AI company in the way that people think about it? Palantir provides data integration and analytics platforms. They help organizations make sense of complex data. Yes, they're incorporating AI and machine learning into their products. Their AIP, artificial intelligence platform, has been a growth driver. But at its core, Palantir is still a software company selling licenses and services. They're not creating foundational AI models like OpenAI. They're not manufacturing AI chips like NVIDIA. They're building applications on top of existing AI technologies. Now, that's a perfectly good business. There's nothing wrong with being an enterprise software company. But enterprise software companies, even great ones, don't typically trade at 60 times sales. Salesforce, one of the most successful software companies ever built, trades at about 8 times sales. ServiceNow, another high-growth enterprise software darling, trades at around 20 times sales. Even at the peak of their growth phase, these companies rarely exceeded 30 times sales. So why is Palantir trading at 60 times sales? Because investors are treating it like it's the next NVIDIA or the next Microsoft. They're projecting growth rates that may not be sustainable and applying valuations that assume Palantir becomes one of the most dominant technology companies in the world. But the path from a $2.8 billion revenue business to a $50 or $100 billion revenue business is long, uncertain, and filled with competition. Let me talk about the competitive landscape, because this is crucial to understanding Palantir's long-term prospects. Right now, Palantir benefits from several advantages. They have long-standing relationships with government agencies, particularly in defense and intelligence. These relationships create sticky revenue and high switching costs. Once an agency has integrated Palantir's systems and trained personnel on them, moving to a competitor is difficult and expensive. In the commercial market, they're building a similar dynamic. Companies that adopt Foundry and integrate it deeply into their operations face significant switching costs. This is Palantir's moat, and it's real. But moats can be eroded, especially in technology. Let me explain why I'm concerned about Palantir's competitive position over the long term. First, the big technology companies are investing heavily in similar capabilities. Microsoft, with its Power BI and Azure Synapse Analytics, is building data integration and analytics tools. Amazon has AWS analytics services. Google has BigQuery and Looker. These companies have deeper pockets, larger customer bases, and existing relationships with the same enterprises that Palantir is trying to sell to. Now, Palantir bulls will argue that Palantir's software is more sophisticated, more integrated, and purpose-built for complex decision-making. That may be true today, but technology advantages in software are notoriously difficult to sustain. What's cutting edge today becomes table stakes tomorrow. Microsoft, Amazon, and Google have armies of engineers and billions to invest. They can close capability gaps relatively quickly. Second, there's the open source competition. The data analytics and AI space has vibrant open source ecosystems. Tools like Apache Spark, TensorFlow, and various Python libraries allow companies to build custom solutions. Yes, this requires more technical expertise, but large enterprises have that expertise. For companies with sophisticated data science teams, the decision becomes, do we pay Palantir millions of dollars annually, or do we build our own solution using open source tools? Third, there's pricing pressure. Palantir's contracts are expensive. When they're selling to governments with large budgets and critical national security needs, price is less of an issue. But in the commercial market, where companies scrutinize every software expenditure, Palantir faces constant pressure to demonstrate ROI. If competitors offer similar functionality at lower prices, Palantir will face a choice: cut prices to remain competitive or lose deals. Fourth, there's the customer concentration risk. Government contracts represent 55% of Palantir's revenue. That's a lot of eggs in one basket. Government spending is subject to political whims, budget cycles, and shifting priorities. A change in administration, a budget crisis, a shift in defense priorities, any of these could impact Palantir's government revenue. We've seen this before with defense contractors. When the music stops, it stops fast. The commercial business is growing rapidly, which is positive. U.S. commercial revenue grew 121% year over year in the most recent quarter, but it's still relatively small at about $400 million quarterly. To justify the current valuation, this business needs to become much, much larger. That means Palantir needs to sign thousands of new customers and dramatically expand average contract values. That's a tall order in a competitive market. Let me address the arguments that Palantir bulls make, because I want to be fair to both sides. I've always believed that you should be able to argue the opposite side of your position as well as your own. So let me lay out the bull case for Palantir and then explain why I think it's flawed. The bull case goes like this. Palantir isn't just a software company. It's a platform. company with a unique ability to integrate disparate data sources and provide actionable intelligence that no competitor can match. They have sticky government contracts that provide a stable revenue base. They're expanding rapidly in the commercial market, particularly with their AIP platform that makes AI accessible to enterprises. They have exceptional unit economics with gross margins exceeding 82%. They're generating substantial free cash flow. They have a visionary CEO in Alex Karp who has built a unique culture, and they're positioned at the intersection of multiple megatrends: AI, big data, national security, and digital transformation. It's a compelling story. I understand why people believe it, but let me poke some holes in it. First, let's talk about those sticky government contracts. Yes, government customers are loyal once you're in, but getting in is hard, and staying in requires continuous contract renewals and expansions. Palantir has benefited from the post-9/11 focus on intelligence and counterterrorism, but priorities shift, budgets change, political winds change direction. There's also reputational risk in the government space. Palantir has faced criticism from privacy advocates and some politicians about the nature of their work and their data practices. If political sentiment shifts, if there's a scandal, if a major contract is lost, the stable government revenue base becomes less stable very quickly. Second, let's examine the commercial growth story. Yes, U.S. commercial revenue grew 121%. That's spectacular. But it's growing from a small base. It's always easier to double a small number than a large one. As the commercial business scales, growth rates will naturally decelerate. Can they maintain 50, 60, 70% commercial growth as the base gets larger? History suggests no. Moreover, the commercial market is far more competitive than the government market. Commercial customers can switch more easily. They're more price sensitive. They have more alternatives. Palantir needs to prove ROI quarter after quarter, customer after customer. That's a harder business than selling to government agencies with national security imperatives. Third, there's the assumption that AIP will be a game changer. Maybe it will. But let's be honest about what AIP is. It's essentially a toolkit that makes it easier for non-technical users to leverage AI within Palantir's platform. That's useful, but it's not revolutionary. Every major software company is building similar capabilities. Microsoft is integrating Copilot into its entire suite. Google is embedding AI into its products. The idea that Palantir has a multi-year lead in making AI accessible to enterprises is questionable at best. Fourth, let's talk about those gross margins of 82%. Yes, software has great economics once you build a platform, but Palantir's business model isn't pure software as a service. They deploy forward-deployed engineers to work directly with customers. These engineers are expensive. As Palantir scales, they need more of these engineers. That creates a natural limit on how much operating leverage they can achieve. Their operating margins, while improving, are nowhere near the gross margins because of these costs. Fifth, there's the corporate culture issue. Alex Karp has built a unique culture at Palantir, and that's admirable. But unique cultures can also be limiting. Palantir has a reputation for being difficult to work with, for having unconventional business practices, for being unwilling to compromise. That works when you're selling to governments who need your specific capabilities. It's harder in the commercial market where customers expect a certain level of flexibility and service. Now, let me talk about valuation from a different angle. Let's look at Palantir's valuation relative to other software companies. Salesforce, with $34 billion in annual revenue, trades at a market cap of about $280 billion. That's about 8 times sales. ServiceNow, with $10 billion in revenue, trades at about $200 billion in market cap. That's 20 times sales. Snowflake, another high-growth data company, trades at around 15 times sales. Palantir, with $2.8 billion in revenue trailing and maybe $4.4 billion this fiscal year, trades at $180 billion. That's 64 times trailing sales, or roughly 41 times projected fiscal year 2025 sales. Even if we're generous and use the higher revenue projection, Palantir trades at multiples that are double or triple what other high-quality software companies command. Why should Palantir trade at such a premium? The bull case is that growth justifies it. But Salesforce grew revenue at 50+% for many years and never traded at these multiples. ServiceNow has been a growth machine and doesn't trade at these multiples today. What makes Palantir so special that it deserves valuations that are completely disconnected from the rest of the software sector? The answer, I believe, is narrative. Palantir has captured investor imagination with the story of AI, big data, and national security. It's a compelling narrative, but narrative isn't value. Narrative is the story we tell ourselves to justify prices that make no mathematical sense. Let me share something else I learned from the dot-com bubble. During that period, certain stocks became momentum plays. They went up not because fundamentals improved, but because they were going up. Investors bought them because they feared missing out. Day traders piled in. Retail investors used them as lottery tickets. The valuations became completely untethered from any reasonable assessment of business value. Palantir has some of those characteristics today. The stock has appreciated over 170% in 2025 alone. Retail investors love it. It's one of the most discussed stocks on social media. Options trading in Palantir is enormous relative to the underlying stock. These are all signs of speculative excess. When Michael Burry, the investor who correctly predicted the housing crisis in 2008, placed $912 million in put options against Palantir, the market should have paid attention. Now, I don't agree with Burry on everything, and he's made wrong calls. But the man has a track record of identifying bubbles. When someone with his analytical rigor takes a nearly billion-dollar bearish bet, it's worth considering his perspective. Alex Karp dismissed Burry's position as bat crazy. That kind of rhetoric from a CEO concerns me. When management starts calling critics crazy rather than addressing their concerns substantively, it often signals that valuation has reached levels that can't be defended with data. Confident management welcomes skepticism and addresses it thoughtfully. Defensive management attacks critics. Here's another way to think about the valuation. Palantir's enterprise value to free cash flow ratio is about 100. That means you're paying $100 for every dollar of free cash flow the company generates. Now, free cash flow is what's left after a company pays all its bills and makes necessary investments. It's real money that could be returned to shareholders. Paying 100 times free cash flow means you're betting that Palantir can grow its cash flow substantially for decades. But here's what history teaches us. No company maintains hypergrowth forever. The bigger you get, the harder it is to grow. When you're already valued at $180 billion, where does the next $180 billion come from? Let me put this in perspective. Using companies, I understand. Berkshire Hathaway, which I've built over 6 decades, has a market cap of about $1 trillion. We generate roughly $40 billion in annual operating earnings from dozens of businesses across insurance, railroads, energy, manufacturing, and services. We have $382 billion in cash and treasury bills. We own stakes in Apple, Coca-Cola, American Express, and Bank of America. Palantir, with $2.8 billion in revenue and $1 billion in profit, is valued at nearly 1/5 of Berkshire's market cap. Does that make sense? Is Palantir's business 1/5 as valuable as all of Berkshire's diversified businesses? I don't think so. Or consider Walmart. Walmart generates $650 billion in annual revenue, employs 2.1 million people, operates over 10,000 stores worldwide, and has been paying dividends for 50 years. Walmart's market cap is about $650 billion. Palantir, with a tiny fraction of Walmart's revenue, people, assets, and cash flow, is valued at $180 billion. That's more than 25% of Walmart's valuation. Does Palantir's business justify being worth 1/4 of what Walmart is worth? I struggle to see it. These comparisons might seem unfair. Palantir is growing faster than Berkshire or Walmart, but growth alone doesn't justify any price. Growth has to be weighed against current valuation, competitive position, market size, execution risk, and dozens of other factors. When I do that analysis for Palantir, I can't justify the current price. Let me address one more aspect of Palantir's business that concerns me: customer concentration. In their most recent quarter, Palantir had 597 total customers. Their average revenue per customer is therefore about $4.7 million annually. Now, they're adding customers at a decent pace, but they need to add hundreds of new customers every year just to maintain current growth rates, let alone accelerate. Moreover, we don't know how concentrated their revenue is among their largest customers. If a significant portion of revenue comes from, say, the top 20 government contracts, then losing just one or two major contracts could materially impact revenue growth. That's a risk that isn't reflected in the valuation. There's also the international dimension. Palantir's international commercial business actually declined 3% in the most recent quarter. Management acknowledged they're focused on accelerating U.S. growth, which is a polite way of saying international growth is stalled. For a company valued at $180 billion, having one entire segment declining is a red flag. The international market represents a huge opportunity, but also huge challenges. Different countries have different data privacy laws, different regulatory environments, different competitive dynamics. Palantir's approach and reputation that works in the U.S. may not translate internationally. If they can't crack international markets, their addressable market is smaller than bulls assume. Now, let me talk about the macroeconomic environment, because that matters too. We're currently in a period of relatively low interest rates compared to historical norms, though rates have risen significantly from the near zero levels of the pandemic era. But valuation multiples are sensitive to interest rates. When rates rise, the present value of distant future cash flows falls. This matters more for high-growth companies like Palantir, where most of the value is in cash flows 5, 10, 15 years in the future. If interest rates rise further or simply stay at current levels, valuation multiples across the entire market will face pressure. Companies trading at extreme multiples like Palantir will face the most pressure. Even if Palantir executes perfectly, the stock could fall simply because investors decide they want a lower multiple. That's not a business risk, that's a valuation risk. And right now, the valuation risk is enormous. I also worry about what happens when the AI hype cycle matures. Right now, every company wants to talk about its AI capabilities. Every software vendor is adding AI features. AI is the buzzword that opens doors and justifies premium prices, but hype cycles always moderate. At some point, customers will move from "we need AI" to "show us the ROI from AI." That shift will separate companies with real value propositions from those riding the hype. Palantir may be in the former category. Their software may deliver genuine value. But even if it does, the transition from hype-driven buying to ROI-driven buying will slow growth and compress valuations across the sector. Palantir won't be immune to that dynamic. Let me share something about how I think about risk. A lot of investors focus on the potential upside of an investment. What could go right? How much could I make? But I've always been more focused on the downside. What could go wrong? How much could I lose? If you avoid the big losses, the winners will take care of themselves over time. With Palantir at current prices, the downside is significant. The stock is priced for near perfection. If execution falters even slightly, if growth slows even to still impressive rates, if competition intensifies, if any number of normal business challenges emerge, the stock could easily fall 50, 60, even 70%. That's not a doomsday scenario. That's what happens when a stock trading at 60 times sales reprices to a more normal 20 or 30 times sales. The upside, meanwhile, is capped by the law of large numbers. Even if everything goes perfectly, even if Palantir executes flawlessly and becomes one of the great software companies, the stock might double or triple over 5 years. But you're taking massive downside risk for moderate upside potential. That's not an attractive risk-reward ratio. I've been in situations before where I passed on stocks that subsequently went much higher. In the late 90s, I didn't buy Cisco, Oracle, or Microsoft, even though they were great companies. Those stocks went up a lot more before they crashed. I was early in my skepticism, but I was right about the valuations, just wrong about the timing. The stocks eventually came back down, and patient investors who waited got opportunities to buy them at reasonable prices. I'd rather be early in my caution than late in recognizing overvaluation. Missing gains is painful, but it's not permanent. Losing capital is both painful and permanent. I can always deploy cash later at better prices. But if I lose half my capital chasing overvalued stocks, I have to make 100% just to get back to even. So where does this leave us? What should investors do about Palantir? First, understand that I'm not saying Palantir is a bad company. I'm not saying data analytics isn't important. I'm not even saying the stock can't go higher in the short term. Bubbles can inflate longer than rational people expect. I learned that lesson painfully in 1999. What I'm saying is this: at $180 billion, Palantir is priced for a future that may not arrive, or may arrive, much slower than expected. The margin of safety is gone. You're paying 64 times sales and 200 plus times earnings for a company in a competitive industry with uncertain long-term prospects. That's speculation, not investing. If you own Palantir, I'd suggest you ask yourself a simple question. If the stock fell 50% tomorrow, would you buy more with both hands? If the answer is no, then you might be overexposed. I've always believed that you should only own as much of a stock as you'd be comfortable buying more of if the price drops significantly. For those who don't own it, I'd urge patience. I know it's hard to watch a stock keep going up. I know you feel like you're missing out. But missing out on overpriced gains is not the same as missing out on good investments. The best investment opportunities come when others are fearful, not when they're euphoric. Here's my advice, and it's the same advice I've given for 70 years. Invest in businesses you understand at prices that make sense with a long-term time horizon. Don't chase performance. Don't buy stories. Buy businesses. Don't pay attention to what the stock does day to day or even year to year. Focus on the underlying business value. Right now, I can't make the math work on Palantir at anything close to current prices. Maybe I'm wrong. Maybe the data analytics revolution will unfold exactly as optimists predict, and Palantir will maintain its position for decades. If so, I'll miss out on some gains. I can live with that. What I can't live with is losing my shareholders' money buying into a mania at the top. I made that commitment to myself back in 1956 when I started my partnership, and I've kept it ever since. I'd rather explain why we didn't participate in gains than explain why we participated in losses. The beautiful thing about investing is that you don't have to swing at every pitch. You can stand there with a bat on your shoulder, waiting for your pitch for as long as you want. There's no called strikes in investing. You only swing when you see an opportunity that makes sense. And Palantir at $180 billion is not my pitch. Time will tell who's right, but I've been in this game long enough to know that in the long run, price and value converge. Always have, always will. I started this talk by saying that Palantir reminds me of a party that's gone on too long. Let me end with this thought. Every great party eventually ends. The music stops, the lights come on, and people realize they need to go home. The data analytics revolution is real. It will change how organizations operate. Companies will benefit. Efficiency will improve. Better decisions will be made. I don't doubt any of that. But revolutions don't justify any price. Good businesses can be bad investments if you pay too much. I've lived through enough market cycles to know that today's obvious winner often becomes tomorrow's cautionary tale, not because the company failed, but because investors paid prices that had no relationship to value. So I'll leave you with the same principle I started with, the principle Ben Graham taught me 75 years ago, and the principle that's guided every successful investment I've ever made. Price is what you pay, value is what you get. At $180 billion and 64 times sales, Palantir's price has gotten far, far ahead of its value. And when that happens, gravity eventually wins. It always does. Stay rational out there, and remember, the most important quality for an investor is temperament, not intellect. Thank you for listening.